Hey, listeners. Today we had on Carlos Gonzalez Campo, analyst at Blockworks Research. In this episode, we slowed down to just take stock of the Solana world and hit on some narratives that we haven't focused on as much in the past couple months of craziness. We talk about SIMD 96, a Solana update that stopped burning half of priority fees, which are optional extra fees users pay to land transactions. TLDR, things haven't quite shaken out how you might expect. We also talk about the meme coin launchpad Pump.fun building its own automated market maker platform and what that could mean for Radium, Pump's current AMM partner and one of Solana's biggest DeFi platforms. Let's get into it. Digital Asset Summit in New York is right around the corner. Some of the biggest names in crypto and several major institutions are going to be there. There's a lot of noise in crypto right now, and I think this conference will be pretty high signal. We're doing a live Lightspeed taping with Solana's co-founder Anatoly and Kyle from early Solana investor Multicoin Capital, so you won't want to miss that either. I hope to see you all there, and you can use the code Lightspeed10 for 10% off tickets at checkout. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanek, joined today by Carlos Gonzalez Campo from Blockworks Research. Carlos, thanks for coming on the show.
Thanks for having me on. It's a pleasure to be here, Jack.
So I wanted to have you on, Carlos, because you just wrote a research report looking back on the month of February for Solana, which was an excellent report, by the way, very well done. And I thought it would be good just to slow down for a second and take stock of things, because as I was reading through this report, it really struck me that there are so many interesting stories and trends that have gone unnoticed because everything is moving so fast. We had meme coin craziness in February. We had all sorts of headline dominating craziness. And so I think now could be a good moment to just slow down, go through what we missed on this show, and just take stock in a broader way. And so I think where I want to start, and one of those stories that I don't think we've covered enough, to be honest, is SIMD 96, which was activated this month, and it began sending 100% of priority fees to validators, whereas before 50% of fees were burned, 50% went to validators. So that was a pretty big change to how the network operates. And it was a pretty big deal when it got voted on in, I believe, mid-2024, but it just gets talked about less today. So, Carlos, when you dug into the data around SIMD 96, what stuck out to you? What did you notice about how that activation has gone roughly a month in now?
Yeah, absolutely. So SIMD 96 was activated on February 12th, I believe. And I think it's important to take a step back and think about what was the goal of this proposal. So the basic goal of SIMD 96 was to discourage out-of-protocol arrangements for transaction inclusion. If you think about it from like an economic perspective, the 50% transaction fee burn from the priority fee was sort of like a tax to the validator. So a rational validator who has the option between, let's say, Jito tips and priority fees, and they are taxing you 50% on priority fees, but they're not taxing you anything on Jito tips. Obviously, you prefer to use other mechanisms for transaction inclusion. So in that regard, SIMD 96 kind of fixed like a bug in the protocol, but it also had some unintended consequences that I think are interesting and important for Solana. So like roughly 3 weeks in, what we've noticed are three things. The first thing is increased inflation in the network. So prior to the activation of SIMD 96, we had big levels of activity on the network, and hence we had a lot of priority fee burn, which offset some of the inflation. So inflation before SIMD 96 was around 3.7% annualized. And since the activation of SIMD 96, inflation has gone up to around 4.6%, which is obviously like 1% annualized, like an increase in inflation. And we can talk about this later, but this has turned the attention back to like this SIMD 228 proposal on the inflation. So that's like the first effect. The other effect is it has had an effect of a reduction in the token holder net income. So to give a little bit of context, when validators receive issuance rewards, they are able to share those rewards with stakers natively in the protocol by setting just a commission that they take from the rewards and then distributing the rest to the stakers. But there's currently no in-protocol way in Solana to share priority fees back to the stakers. So what's happening right now is that previously 50% of that priority fee was burned. Now the validator keeps 100% of it, and they don't distribute anything back to the stakers. So there's this kind of like misalignment between the validators and the stakers that needs to be fixed. And SIMD 123 attempts to like give an in-protocol solution for validators to distribute priority fees to stakers, but it's something that's currently like in the works. It's not something like an immediate solution that's about to hit the market. So there's like a lag of, I don't know, 6 months that we have to wait for that to be activated. And yeah, like many protocols like Jito, Marinade, Sanctum have like offered alternatives for validators to distribute these fees. One example is Jito's tip router, which is the mechanism they use to distribute Jito tips programmatically. You could also use that to distribute Jito tips, but it's not the ideal state. The ideal state would be like just having an in-protocol way of doing that.
Well, and one of the reasons it's not ideal, I believe, is just because it's all pretty opaque as things go. So tip router runs on chain. So like stakers can kind of validate whether their validator is giving them as many rewards as they're supposed to receive. But you mentioned Sanctum. Sanctum has created, I believe, a liquid staking token for every validator, because with LSTs you can pass back priority fees, but it's all off chain. It's just like a kind of a handshake promise of, I think Jupiter's a good actor, and so if I buy Jupe Sol, they're going to pass along the inflation. The downside of tip router, or excuse me, the priority fees. The downside of tip router is that it costs a fee for validators to use. So a validator has to say, there's no in protocol way to verify if I'm sharing my priority fees with my stakers. I have to go and pay somebody a fee to tell me how much of my priority fees I need to send along to my stakers. So it's the current state of things with all the out of protocol ways to share priority fees is like asking, in some ways, validators to go against their own business interests for the good of their stakers. And I don't know if you'd agree with this, Carlos, but I think one of my takeaways from a month into SIMD 96 is that stakers aren't very rational in the aggregate on Solana. Like stakers have not gone where the yield is higher. LST adoption is still 10% last time I checked. It should be much higher, I would think, if you wanted to go and get that increased yield from the priority fees not being burned.
I would largely agree with that. I think that a lot of stakers in Solana are not very sensitive to the staking yield. And I think what you just shared is a reflection of that. I would also agree that this like third-party solutions are not ideal for the reasons you mentioned as well. Like Jito's tip router, for instance, charges a 3% flat fee for the priority fees that would be distributed, with 2.7% of that going to the Jito DAO, and then 15 basis points each to like the Jito Sol and Jito restaking bolts. Whereas SIMD 123 will just provide like an in-protocol way that wouldn't charge you like this sort of like commission rate. And it's also like what you mentioned, right? Like, why would I do that if like I'm just losing money by doing so? So it's kind of like this can't be evil versus don't be evil, where the in-protocol solution like enforces that on chain and like kind of obliges validators to set a commission rate and stick to that. Whereas with the other solutions, you're just kind of hoping for the best, which obviously you don't want to like just rely on good faith. You want to rely on like on-chain verifiability.
So as you explained, the kind of the motivation to pass SIMD 96 at the beginning was that when there's a 50% tax on priority fees, there's an incentive to basically do things out of protocol to get around that tax. So it seems like people were cutting side deals between users and validators where they would say, hey, instead of me paying 100% priority fee and you losing 50% of it to a network burn, I'll give you an out of protocol 75% fee. And then I pay 25% less, you pay 25% more. It's a win-win. And something that you argued, Carlos, that you talk about in the piece is that you could make the case that priority fees would fall after SIMD 96 was enacted because, if before users out of protocol were paying 75% of the priority fee to get around that fee, now it's all in protocol and maybe priority fees only need to be 85, 90% of what they were. But it looks like that was not the case. So walk me through what you're seeing in the data on that side of things.
Yeah, absolutely. If you look at the data, the median priority fee basically remains unchanged. So, like, obviously, we're 3 weeks in from the activation of SIMD 96. So, it's a small sample size where activity on the network has been low. So, we cannot like extrapolate that conclusion, in my opinion, to reach like a definitive SIMD 96 didn't have any effect on priority fees. Maybe in the future it does, but so far it's clear that it hasn't had that effect. Aside from like recent volatility events such as the Trump launch or like the Libra launch, where you had some spikes, the median priority fee basically is the same before SIMD 96 and after SIMD 96. And as you mentioned, like some people had argued that it could lead to a reduction. That includes me as well. I think, or I used to think that it could lead to a reduction in priority fees. And the reason is pretty simple if you like reason about it. Like, let's say a validator requires $5 to include a transaction. Like before SIMD 96, you would require the user to pay $10 because 50% is taxed. So you need like double that amount to receive the $5. And after SIMD 96, theoretically, you could just charge the $5 and allow the user to pay half and still earn the same amount. So that was kind of like the logic behind expecting priority fees to drop, but that hasn't been the case. I couldn't tell you the exact reason why that is, but the data shows that it has had no impact.
Now for a quick word from today's sponsor. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your Solana and logins, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a robust ecosystem of products and services, making digital ownership more secure and accessible to everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, feature the world's first secure touchscreens, making it easier and safer to manage your Solana transactions and coins. With Ledger Live, you can seamlessly and securely manage and stake your SOL. Alongside Ledger Stacks and Ledger Flex, Ledger introduced the Ledger Security Key app, a safer alternative to traditional passwords, enhancing your overall digital security. Thank you to Ledger for making today's episode possible. And the other interesting thing you point out is that priority fees declined as a share of real economic value in February. So not only did the tax go away and the priority fee didn't drop, which you would think would increase the use of priority fees because validators are incentivized to accept them, but proportionally, I'm not talking about in absolute terms because obviously REV in general declined quite a bit in February, but just proportionally, JITO MEV tips increased relative to priority fees, which decreased, which I think is an interesting finding. I don't know what to make of it exactly.
Yeah, I also found it kind of interesting and counterintuitive that in January we had a bigger portion. Well, in January, JITO had like an outage of like 3 hours during the Trump launch, and that caused like some percentage of REV to shift back to priority fees. But yeah, if you look at previous months, like there's no real change in the share of priority fees and Jito tips, in the sense that it hasn't actually discouraged the use of the latter. In my opinion, I mean, there are a couple of reasons that could be. A majority of the network is running on the Jito Solana client, so that may be one of the reasons. Maybe Jito has an edge, like in the block builder engine. The honest answer is I don't know why that is. But yeah, it's an interesting finding. I think the most important thing here is that um, 12 months from now, 6 months from now, to gauge if SIMD96 was successful or not, we need to look at the number of transaction processing units on Solana, or TPUs, which are basically out of protocol services that are used for transaction inclusion. So right now there are about 5 of those. You have like Jito, you have these nodes, you have Bloxroute, and you have others. And this market structure isn't optimal because right now, if you're a developer and you have an application and you want to maximally increase the odds of landing a transaction, you have to use all of this like services, if you will. And obviously that adds complexity in terms of developer resources, and it also adds overhead costs. So the ideal state is where you just have like one or two places. And in the ideal scenario, SIMD96 reduces the number of TPUs in the network. In the worst case scenario, it at least stops the growth of new ones from coming into the network and discouraging these kind of side deals that you were mentioning at the beginning.
Okay, let's move on to some other topics. One that I wanted to get into is the application landscape, and a very big change that happened this month that we didn't talk about a whole ton on this podcast, I don't believe, is Pump.fun, the Solana meme coin launchpad and, insane cash cow in the Solana ecosystem, announced that it's building its own automated market maker and is going to be, well, it didn't really announce this, but word has trickled out and I've confirmed through sources and so forth. It's building its own AMM. It's leaving Radium, which had really, really benefited from being the AMM where Pump.fun tokens, after they're launched, graduate to. So, yeah, with that happening this month, I guess I just want to start with your general take on what's kind of the game theory for Pump.fun here to do this, and what are the implications for Radium if it loses Pump.fun's business?
Yeah, absolutely. Like just taking a step back, like the big story is like the Solana DEX landscape, like DEX volumes have increased dramatically over the past year. And a lot of people have the perception that a big portion of that is driven by meme coins, and they're largely correct. Like if you look at the data, around 60% of DEX volume comes from meme coins in the past few months. So, and the primary beneficiary of that has been Radium. Radium has around 80% of market share when it comes to meme coin trading pairs. And conversely, if you look at the volumes in the exchange and you divide them by asset type, around 80% of the volumes that Radium has come from meme coin pairs. And around 40% of that comes from Pump.fun. So Pump.fun is basically the largest source of new trading volume for Radium. We released like an analysis with Mark Arjun, which is another Blockworks analyst, a few weeks back, like analyzing the effects of Pump.fun launching their own AMM and not graduating their tokens to like Radium. And one of the questions we asked is, well, the coins that already graduated, they're already trading on Radium, so Radium won't lose that volume. But the new coins, they will go to Pump.fun. So what is like more important, right? Like this old coins, or the new ones that haven't that don't exist yet and will exist in the future? And so we looked at the volumes of Radium by pool age, basically. So let's say what percentage of Radium's volume comes from pools that were created in the past 30 days, pools that were created between 30 days and 60 days, and so on and so forth. And our findings were like pretty surprising. We found that around 70% of Radium's volume comes from pools that are less than 30 days old, which is pretty insane statistic in my opinion. And so what that tells you is that for sure what's more important for Radium is like these new coins that are graduating every week, every day, and that are going and trading on that exchange. And if Pump.fun goes and launches their own AMM, they are losing their largest source of volume, and that threatens their position as the dominant DEX, or at least removes a big portion of their forward-looking volumes. And so Radium traded around, like, I believe 30% down on the day the news leaked. And in my opinion, it was sort of like merited, because they are indeed losing a big portion of their volumes on a forward-looking basis if Pump.fun launches.
Just to the extent that you've looked into Radium, like, it was obviously an innovative take on an AMM when it came out. I think most people will say that. Pump.fun hasn't built an AMM. It's not incredibly hard to do so, but are there reasons that it could be negative to leave Radium, which is an established team that is pretty well respected, and try to do your own thing? Like, could that come back to bite Pump.fun?
Honestly, I don't think so. I'm surprised they didn't do it earlier, in my opinion. Like, it didn't make sense just to give that volume all to Radium. Why wouldn't you just take that? Because you already own the user, you already own the distribution. Why not just own the backend as well? And so, in my opinion, it was inevitable. I think like everyone expected it someday to happen. I think Radium kind of also expected it as well. I obviously don't know, but it makes sense, right? They already own the user. Why not just own the backend liquidity as well? But I think like the problem now, if you asked about like probably negative effects that it could have, I think Radium won't sit on their hands like still while Pump.fun takes all the volume. And they could like conversely, just as Pump.fun launches its own AMM, like Radium could launch a fork of Pump.fun and launch their own launchpad, or launch a Telegram trading bot to try to capture some of that volume back with bots, or there are a million ways they could like try to recapture those sort of volumes and try to get closer to the end user. Like, Radium has been one of the best performing tokens in 2024, and a big reason of that is they had a buyback program, and they are a profit generating machine. So in terms of like financial positioning, they remain very robust, and they have the capability of like investing in R&D and these sort of like new experiments to try to gain back that position. So I wouldn't like underestimate basically Radium. I think they can still like make the right strategic moves and gain back the user in that way.
Yeah, I mean, obviously, open source goes both ways. If you can fork an AMM, you can fork a meme coin launchpad. I think my immediate response to that is just that there's been like dozens, maybe several, I'll say, attempts to fork Pump.fun, because there's things about it that aren't optimal. Like, there's a lot of Solana liquidity that just remains trapped in these dead tokens, and there's been attempts to create new meme coin launch pads that solve for that problem. None of them have worked for whatever reason. Like, Pump.fun's usage is really, really sticky, and so even if Radium can create its own launch pad, I'd question its ability to meaningfully create a user base, because I don't know, Pump.fun has the mind share.
I largely agree with that. It's a question of what's more like sticky, right? Like the liquidity backend, like with the liquidity pools, or like the front end where users interact. I think it's clearly like the users. They already go on Pump.fun. They already launch their coins there. They don't care where the liquidity goes. As long as they're able to trade it, they don't really care. Like if it's on Radium or it's on Pump.fun or if it's on another DEX, they really don't care. They just want to trade meme coins.
Now, I will say this. I think the Malay meme coin showed us that there is an iceberg beneath. Like we see the tip of the iceberg on meme coins. There's this whole bit of the iceberg that's underwater that we don't see when it comes to meme coin trading, and there's big whales that are doing maybe illegal things and so forth. And without getting into any of that, I do think that maybe the bit of the iceberg we don't see cares more about liquidity than you'd realize, because obviously there's a lot of retail traders that like to go on Pump.fun and browse the trending tab or whatever. But I think there also could be large whales, people that are driving a ton of trading volume to things like Pump.fun that do actually care about Radium's liquidity and would maybe move over. So if I'm building a case for a world where a future Radium project is able to take back market share, it would probably be for that reason.
Yeah, 100%. I didn't mean that. I didn't mean like traders don't care about liquidity. I mean, they don't really care where it's at. As long as there is liquidity to trade it, they don't care if that liquidity is on Radium or is somewhere else. But as long as you don't have like a lot of slippage and you can trade things, like it shouldn't matter to you as a trader where that liquidity sits, in my opinion.
So just in general, again, in February, REV declined by a lot. I don't have the exact number in front of me. And I think a big reason for that was everyone just got sick of meme coins. The Malay Libra launch was a bridge too far. People started to really feel like these things aren't fair. How concerned are you, I guess, about the app layer on Solana and its ability to continue to see meaningful volumes, knowing that it's really pretty meme coin dependent?
It's a good question. I think REB declined like around 50% in February.
Yeah. Okay.
Obviously, it was hard to match, like the president of the United States launched a meme coin in January, right? It's hard to match that kind of level of activity. And so I think it was somewhat expected, like in retrospect, for volumes to kind of cool down a little bit, to the point of like the LIBRA meme coin and like this sort of like disillusionment with meme coins. I largely agree with that sentiment. I think that every additional public figure that launches a meme coin will have like decreasing marginal returns, to the point like where users eventually become disinterested and disillusioned with these launches for the reasons you mentioned, like insider trading. Like it just becomes like boring after the third or fourth person that does it. So yeah, in that regard, I think that I remain somewhat pessimistic in terms of like meme coin volumes in the next months. I don't think they will match like what we saw in the past, but at the same way, at the same time, you cannot discount like human behavior, and like all it takes is just one meme coin to bring it all back as the way it was before. So yeah, we just don't know. But when we look at like Solana REV, most of the REV on Solana comes from trading focused applications. That can be Radium, that can be Pump.fun, that can be Jupiter, that can be Meteora. But it's clear that there is a very deep correlation between REV and DEX volumes, and meme coins are a big part of that. So if you expect like meme coin volumes to decline significantly in the next 6 to 12 months, then the logical conclusion would also be like for REV to decline as well. And that could have like a more like, let's say, fundamental driven investors or whatever you want to call them, excuse me, like a negative outlook on Sol itself. That being said, I think that Solana is not just meme coins, and the network is reaching a point where it's like in a maturing state. And we are seeing a moment of big institutional interest and also real innovation in DeFi applications. You have things like Amino, you have things like Drift, new institutions like Franklin Templeton launching on the network. And so I think like yes, there is like this meme coin phenomenon. You cannot change like human behavior, but there's also this real innovation that's happening, and that over time I expect to have a bigger share than it has today and make up most of the like sort of DeFi activity that you see on Solana.
Now for a quick word from today's sponsor. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your Solana and logins, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a robust ecosystem of products and services, making digital ownership more secure and accessible to everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, feature the world's first secure touchscreens, making it easier and safer to manage your Solana transactions and coins. With Ledger Live, you can seamlessly and securely manage and stake your SOL. Alongside Ledger Stacks and Ledger Flex, Ledger introduced the Ledger Security Key app, a safer alternative to traditional passwords, enhancing your overall digital security. Thank you to Ledger for making today's episode possible. I also think that real-world assets are primed. I can never say that. RWAs are primed for a comeback. I think that people talk about DePIN a lot as like the real thing that Solana could build, but RWAs were like a big deal, I don't know, a year and a half ago, and it feels like they're talked about a little less, but it's maybe a lower lift to just be tokenizing stocks or whatever, but it's a really big market if you can convince, I don't know, institutions and so forth that like tokenized versions of real things are just more efficient than the current rails.
I don't even think you have to go that far. You can look at like stable coins, which are the most successful RWA that we have. And if you look at stable coins on Solana, like they have grown tremendously in the past 2 months. USDC right now commands around 80% market share on the chain in terms of like stablecoin dominance. And in the past year, they have added like 5x the number, like their supply has grown by like about 5x. So I think like this shows you like institutional interest or inflows are coming to Solana. The network, yes, it may benefit like from meme coins, but that also has like trickle down effects on other things, such as you mentioned, RWAs or stable coins, where stablecoin supply is today at an all-time high. And I don't think that's a thing people really noticed or talk about often, but it's very significant, like, and bullish for DeFi activity on the network.
Oh yeah, totally. I think the tweet I put out is, in the 3 days after the Trump launch, the stablecoin supply on Solana grew as much as it had in the prior 320 days. So it's a year of growth over the weekend, basically, in stablecoins. And you didn't really see a meaningful drop-off in stablecoins in February, which I think is encouraging for Solana. It shows that that liquidity is sticking around. Another interesting point that you make in the report that I hadn't really thought about before is that 80% of stablecoins on Solana are USDC, issued by Circle, very regulatory compliant company that seems to be maybe doing some regulatory arbitrage in Washington right now. Ethereum is 55% Tether, USDT, and Tron is, I would believe, even more. People love their USDT on Tron. So I don't know. That was an interesting point when you look at the regulatory outlook for stablecoins. So maybe walk me through why Solana's USDC dominance could be an advantage.
Yeah, I think like I've always found that interesting. I think not a lot of people pay a lot of attention to that. But yeah, if you look at Ethereum, like USDT commands most of the stablecoin liquidity. If you look at Solana, it's more like this. I don't know how to describe it. Maybe I would describe it as USA aligned or America aligned blockchain. Like you saw Trump put out a tweet saying that Sol, XRP, and ADA would be included like in the crypto reserve. Like obviously, I don't think that's a smart move, but like I think Solana in some way is more like US based, if you want to call it that way, and so it can, I think, better benefit for increasing regulatory like clarity coming from the US with this administration. And obviously, if Circle benefits from that environment and USDC commands 80% of the stable coins on Solana, that can also help the forward-looking growth of stable coins in the network.
And you have to think that Circle is doing a ton of lobbying in Washington and so forth, which I'm not saying that's a good thing for the decentralized, permissionless future, but just in the environment we're in the world that we live in, it seems like Circle has a big advantage over Tether, which they just appointed a new CFO or something to audit the company. Like Tether is really doing a lot to try to prove that it's compliant. I think Circle arguably has done a better job of winning over regulators, showing it that it's this compliant, safe stablecoin. And so, yeah, I do think that Circle is going to press that advantage, and Solana being the network where Circle lives is, yeah, kind of an advantage that I hadn't really thought about before. So that's an interesting point that you brought up.
Yeah, I mean, obviously, Circle is not only on Solana; they also like are on Base. They're on Ethereum. They're on many other chains. But like, yeah, it could like Solana could benefit for sure from that, like increasing like regulatory advantage or clarity. I also agree with you. I don't think it's good to have this regulatory capture by Circle. I think like stable coins should be able to compete on a global scale. I think it's important to have like offshore issuers as well. That being said, we cannot like change the reality, and the reality of things is if that happens, where Circle gets a regulatory capture, where that could like be beneficial for Solana stablecoin adoption.
Mm-hmm. Exactly. Okay, Carlos. Last point I want to hit before we get on out of here is SIMD228 is the big debate recently. I didn't want to focus this episode on it because we've done a lot of content, but I do think an interesting thing you can speak to is one of the so for people who live under a rock, SIMD228 would replace Solana's current set emissions curve with a more market-driven issuance curve, which would essentially lower Solana's inflation and like lower the rewards from issuance that go to validators. Now, one of the points that's being made against SIMD228 is that unpredictable yields can be unappealing to institutional investors. So Lily Liu, the president of the Solana Foundation, has made this point a couple of times. Carlos, you come from somewhat of an institutional background. You were at 21 Shares, I believe, which is big ETF issuer. So I just wanted to bring you in and get kind of your take on what SIMD, like how would institutions, I guess, view SIMD 228 in your opinion?
Yeah, I think there's an underappreciated aspect of Lily's argument that not many people like understand how it works in practice. So SIMD 228 will lead to a reduction in the yield. That, of course, reduction will be the nominal yield. The real yield will be largely the same. But a lot of institutions don't really know where that comes from. So they don't really care if it's coming from inflation or it's coming from like network fees or Jito tips. That's just first off. Like, unfortunately, institutions are not as sophisticated as one would hope. The second thing is inflation sort of works like a subsidy from the network to these kind of institutional players. Like, so from a practical perspective, a crypto ETP issuer, what they can do is they can offer a staking ETP. For instance, 21 Shares have a staking Sol ETP, which is the largest in Europe, I believe. And so what they do is, or what they can do is they can keep a portion of the staking rewards to cover the cost of the ETP, and in that way they can like offer lower management fees on the ETP. So with a regular ETP, you usually have like management fees over assets under management. Whereas if you're keeping a portion of the staking yield, you're kind of subsidizing the cost of the ETP, if that makes sense. So you don't have to charge management fees to clients, or you can give yourself the luxury of charging very low management fees. And so from the point of view of the institutional client, you have a product that doesn't have any management fees. You have a product that's on top of not charging any management fees, earning you some kind of yield, and you have exposure to the underlying asset which is Sol. So that's great, like from your point of view. Like as I mentioned, I am aware that that yield is coming from like nominal inflation, but a lot of these institutions don't really see that distinction. And so I can see the scenario where if yields drop after CMD 228, then maybe the staking yield is no longer enough to offset the cost of the ATP, and you have to offer clients somewhat larger percentage of management fees, and you can see that clients no longer like have an interest in the product. That being said, if an institution doesn't want exposure to Sol because they don't get like 2 or 3% extra basis points, I don't think they really understood like the Solana thesis. And I largely agree with like the other side of the argument, which was made like by the multi-coin guys and many other people who said, I think Dan Smith also said this, that you don't want to basically own a 70% bull asset because it offers like a 5% yield. Like unless like you can see in the past week, Sol dropped down more than whatever it could give you in yields. So I don't think people own Solana because it offers like a cash flow. It's a mistake to equate it to a like safe bond or stock paying a dividend or whatever. I think it's like more analogous, if you want to look at it that way, to a growth stock and like a growth story. And yeah, I largely think like CMD 228 can be beneficial for the network as a whole and reduce like selling pressure coming from basically issuance rewards, and also like reduce the dilution of naked Sol holders.
Okay, and while we're on the subject, I also want to ask, I think our last episode on the topic, we didn't really walk through this distinction as well as we could have. So last question, explain to me, people talk a lot about the difference between the nominal and real yield when we're looking at reducing the issuance on Solana. So why are the real and nominal yields different? Just explain that distinction.
So the nominal yield is coming from issuance, is what you call issuance based. So that's coming essentially out of nowhere. It's just diluting the naked Solana holders because you're creating Sol out of thin air. So you're not creating any value there. That's why it's nominal. It's just like issuance based, and it's just like a tax on non-stakers, if you will. The real yield is coming from what you can call cash flows. So it's coming from true economic demand to transact on the network. And that comes in the form of priority fees and Jito tips primarily. And that is passed down to like stakers and validators. And that is real yield because it's coming from cash flows similar to a company like charging for a product and then generating a profit and giving a dividend to their like stockholders. That's why the distinction between like nominal and real is very important, because nominal is just an accounting trick that essentially dilutes naked Sol holders, and maybe it gives you the illusion of receiving some sort of yield, but you're just like depreciating the asset. You're not really doing anything, not creating anything of value.
Yeah, it's important to note these differences. Carlos, thank you so much for coming on the show.
Thank you, Jack. It was a very fun conversation. Thanks for having me.
All right, everyone. Appreciate you for listening. Make sure to grab your DAS tickets. We're coming down the pipe until that happens in New York City later this month. Please give us a 5-star rating. If you've enjoyed this podcast, please share it with a friend, and we'll see you all again very, very soon.